Okay. What we're going to talk about now is syncing up your stock trades, your equity trades with the index correctly. All right, this is like kind of like the next step. Once you learn how to actually do a trade, understanding trend, understanding where to enter, entry, exit, sizing, all that kind of stuff. A way to really increase the probabilities of performance of your trade is to sync it up correctly with what the market's doing. Your long trade or short trade has a much better probability of success, exponentially better, I would say, if you are trading in sync with the market action. Meaning, if the market action is going up, your long trades are going to work. Your short trades aren't. If the market's going down, your short trades are going to work. Your long trades typically are not going to work. Now, this is it forces you to really kind of wait for the right entry. But let's just dive into it. Let's just jump in. Let's just kind of try to take a shot at explaining this. And it's a little more of a skill than a science. But let's go for it. All right. So the first thing is this. I got this diagram, this picture up here, and the secret, for me at least, to doing this the right way is to understand the trend structure and understand the impulse and corrective elements of that structure. Okay, so first, let's imagine, and I'm just showing a downtrend in the S&P because we're currently in a downtrend in the S&P. The S&P is the main read. That's your main focus. The equity trade is secondary to what the index is doing. So if I'm looking at the S&P and I see it's got a really well-structured downtrend, impulse, correction, impulse, correction, impulse, right? All right, so just assume that's our starting point. We get this nice downtrend. When you take these 500 stocks in the S&P and you break them down one by one and look at them, what you're going to see is if the trend's down, most of the trends within the S&P will be down. And we'll call those in phase. These downtrends within this S&P 500 are in phase with the S&P, meaning that the impulse and corrective sequences should be fairly closely matched. If the S&P is in an impulse move down, then the in-phase stocks would be downtrends with an impulse move going down. When the S&P goes into an up phase, which is corrective within this downtrend, the in-phase stocks would also be in a corrective phase. So basically, they're just going to match up. They should match up identically. Now, then what's the problem, right? Why would we, if they're moving in phase, you just move in trade with the downtrend? Yes. So when the market's in a downtrend, the stock's in a downtrend, why wouldn't I just trade the market? Why wouldn't I just trade the X&P, SPYs or something instead of finding the equities? Well, that's a good question. The answer is the individual equity is going to have a lot more volatility, right? So you're going to get more bang for your buck volatility-wise. You're going to get bigger moves on a percentage basis from the individual equities. So because it's the S&P's 500 stocks, the volatility is muted and you're not getting as exaggerated moves. So it's really a way to lever up, another way to lever up my S&P trade. Now, what you should see is this. Just to explain this part first. Let me spread that out a little bit. When the S&P pulls up like this in a corrective move, the stock, the in-phase stock, should also pull up in the same corrective move, just like this. So they're both in corrective uptrends. Now, when the S&P hits or it gets ready to reverse right here from this. Now, typically, I don't want to trade long. That's a common question. Like, do I want to try to take these trades long off these lows? No, because these are counter trend moves. They're not powerful. They're weak. They're non-directional. I shouldn't say non-directional. They're not impulsive. They're not a lot of energy behind them. What I'm really trying to figure out is where this is going to stop pushing back and start to fail again. So like this. I'm really trying to figure out where this turning point is. And if you've followed that in my stuff before, you've seen me demonstrate that many times. Like, we're trying to figure out where this change is going to be as it goes from a correction. Let me just steal this. From a correction to an impulse. Whoops. All right, my bad. All right, so this would be the future that we would be looking for. Let me make that green so we know that's the future piece right there. All right, now when this turns, we're typically trying to figure out maybe it's a supply zone, maybe it's something along those lines that would turn it, whatever your entry signal is going to be. When you see it hitting that area that you think it's going to turn, that's when you go ahead and you look at your in-phase stocks. So basically, you're looking at this. You see this going into a counter trend move against the downtrend. You think it's going to turn somewhere, let's say in this area. And at that point, you say, okay, I think it's going to turn back down and resume this downtrend like this. Let me go to my in-phase stocks that are in downtrends right now, and let me find one that is also moving up in a, let me make this green, in a counter trend fashion. And if I go through my list of downtrends, I should see one or many that are coming up and hitting some kind of turning point. That could be a falling VWAP. That could be supply zones. Whatever entry signal that you use. It comes up, hits that, and I'm expecting the market to turn down. And right in sync with the market, I'm expecting my stock to turn down right along with it. Now, the difference should be the stock should go down a lot more percentage-wise. If I'm choosing my stocks correctly, looking for high beta, higher volatility, it should go down more percentage-wise than the index goes down. All right, so that's a way to be more aggressive, right? All right, that's trading in phase, and that's just bread and butter stuff, right? When I think I'm watching the S&P, that's my main read. When I see the S&P coming back within the structure with a counter trend move back to a spot that I think it should stop and reverse, then that's where I go ahead and jump into my in-phase stocks, into my screeners, find my stuff that's all in downtrends, simultaneous with the S&P 500, and I start going through those, looking for something that's in a counter trend move. Here's the counter trend move, looking to become a new impulsive move to the downside, in sync with the S&P 500. Okay, now, let me get rid of this. What happens when I see, say, the S&P right here? That's my main read, the S&P. And let's just say it hit a higher time frame demand zone, or it hit some support at this level, say down here. Now, let me make this red, so this is like we're in a trend. Okay, so here's the 1, 2, 3, 1, 2, 3, 1, 2, 3. Now, let's say we hit down here, and what I'm anticipating is that because it's hitting a pretty we're in a primary downtrend, but because it's hitting Important structure, could be a big demand zone, could be some kind of support that's in there. I'm expecting it, or it's oversold, it's really extended. I'm expecting it here to bounce back across the range in a counter trend move. Like, that's what I'm expecting. I'm expecting the counter trend to come off of here, leading to a new impulse move down. But where we're at the moment is right there. All right, so the impulse is overreached on downside in this case, and I think it's going to bounce off of some important structure. How do I take advantage of that trade? I don't want to go long this trend, right? That's dangerous. The counter trend could be weak, it could fail quickly, a lot of things could happen that wouldn't be beneficial to me. I need more odds in my favor for a successful trade. What I'm going to do in this case is, because I'm anticipating a bounce here, I'm going to go to my out of phase stocks. All right, now these are stocks within the S&P 500 that are moving up while the market's moving down. Could be all sorts of reasons for this. Maybe the company's got really good fundamentals going on. One that jumps out at me right now is Deckers Outdoor. They've got a new shoe line that's super popular, and their numbers would just blow out. And while the market's going down, the stock's been jumping up. Eli Lilly's one that's been going up while the market's going down. There's names like this. Okay, so what's going to happen here is this. When we say it's out of phase, what we're referring to is that the impulse and corrective sequence, impulse, correction, impulse, correction, impulse that you see here, are reversed to what the index is doing. So when the index is in a corrective move, like here's a corrective move up, that's when this is in an impulse move up. When the index is in an impulse move down, that's when the stock is in a corrective move down. All right, so impulse and corrections. The impulses are to the upside, the corrections to the downside, while in the market at the same time, the impulses in the market are to the downside and the corrections are to the upside. So the impulse and corrective sequence is out of phase. It's out of phase, it's opposite. All right, so when this impulse move in the index is coming down, and say down to this important level that we identified, whatever it was, we look over here at the out of phase stock, and that is currently in a corrective move down. So the index is in an impulse move down, the stock is in a corrective move down. Okay, so what I'm going to look for is one of these out of phase stocks that's in a corrective move down and possibly coming to some sort of, let's say, demand zone. Say there's something in this area. It's got to be in the remember how we structure our trades, right? We're looking for entries along the last impulse wave. Just refer to one of the past videos on trade entry or on finding a good trend, and we'll talk about that. All right, so it pulls back to the, say, demand zone or entry point of your choice. And what we're going to do is we're going to buy it simultaneously or in conjunction with the S&P hitting its supply zone or support zone, demand zone. So here's the demand zone in the S&P. Here's our demand zone in our stock. Our stock's in a corrective move. The S&P is in an impulsive move. Now the S&P hits this and pulls up in a corrective move. So I'm going to put the correction right there. It pulls up in a corrective move. At the same time, and we typically don't want to buy corrective moves. They're weak. They're easy to fail. We do is we buy at the zone, and we're looking for a new, I ran out of room here, impulsive move to the upside. Let me grab that. This new move to the upside here is going to be impulsive. So the pullback is corrective, and then impulse, correction, impulse. And we just identified this turning point right here. So as this pulls up, as the market pulls up, you'll see this develop in a corrective move. The market pulls up in a corrective move. The stock will pull up in an impulsive move and surge forward. We're always trying as traders to capture the impulsion moves of trends, not corrective. The impulsion move is like a strong, surging upside or downside motion that really carries through. Corrections are weak and fail easy, and they don't have a lot of energy behind them, and they're more related to noise or static. All right, so that's the concept. Hopefully everybody get the concept. Now, when you look at the market right now, and here's the SPX, and let me put the watermark back up here. Okay, so here's the 1 hour chart in the SPX. Again, equity indexes, I like to use 65 minutes. So we'll do an hourly chart here. And you can see the structure really clearly. That's an impulse, that's a correction, that's an impulse, that's a correction, that's an impulse. Okay, so we're currently in this time frame, 65 minutes, we are in a downtrend. This is the structure: impulse, correction, impulse, correction, impulse, down. Just like that. Now, what we'd expect to see, the anticipated motion here would be a correction. And that correction could be anywhere from here to the top of this box. So let me just, the top to this prior swing high here. All right, so there's a swing high. This is the last impulse wave. So this correction can be anywhere just short of this, where it's going to stop and become a new impulse wave to the downside. All right, so first thing we got to do is make our guess as to where this is going to stop. All right, so I'm going to use a technique I used in the last video. All right, we're going to look for zone here. I'm going to use starting with this, see this, where this really sharp drop kind of kicks off here. I'm going to grab the high point of that drop. And I got some zoning activity right here. If you see, I've got a drop, a base, and a drop right there. You see how it goes sideways? It goes sideways right here. That's going to be what we call a zone. In this case, that's a supply zone. So motion, halt, motion. I'm going to mark this area off right here. And that's going to be a supply zone that I'm going to use. All right. And we see that that's coincidental with the falling VWAP, anchored VWAP. So starting from here, anchored the VWAP, volume weighted average price from the start of the decline. And we can see that, and what this is telling us, the anchored VWAP is telling us, is that of all the trades that happen in here up to this point, the average price of all the stuff that's happened so far is 42.28. All right, right in this area, which happens to overlap with our zone, which is really good. And for further confirmation, I'm going to look at the fixed volume profile chart. All right, and the fixed volume profile chart shows where, and this is along this impulse, I anchored it from the start of this thing to where it ends. Most of the volume, or the peak in the volume turnover, is right at our zone again. And this is what's called the point of control. The red line right there is called a point of control. It's like the peak in a bell curve, you know, like the mean, like where most of the trades actually went off. And we can see there's some pretty good volume below it, but that's the high point. So we see the point of control, and we also see the VWAP, all telling us that this is probably a pretty good zone right here. All right, so what we're going to expect to happen is this. We're going to look for this to keep rallying until it kind of matches up right here. I'm going to use the definitely closer to this VWAP for an entry. I'm going to expect it to hit right about here and then drop off in a new impulsive move down. So this move up can be weak. It could fail short. It's like a little less predictable what it could do. It could spike real quick and fail real fast. It could do a lot of things. We're not I'm not particularly interested in trying to get long and ride that up. I don't see that as being a great trade. I'm more interested in trying to catch it where I think it'll turn and I can control my risk better, and then look for a new drop to the downside. Now I could just trade the S&P like this, or what I could do is, well, hold on. Let's talk about two things. One, we'll talk about setting up our short trade right here. But I said I don't want to trade this to the downside because, you know, this is not what I'm looking for, right? This is I don't want to trade against the trend, essentially, right? So I'm not going to look for a short trade right now. I'm going to wait until it hits here. But maybe what I could do is look for a long trade, right? Now, I'm going to go to the stocks that are out of sync, that are out of phase. All right, so a couple names that in a quick little review that I did, an example of an out of phase stock would be something like this. This is, hold on. Let me put up another chart. Let me erase all this. Okay. TradeWeb. Now you can see here, this has been going up while the S&P has been going down. That's interesting, right? So there's some good stuff going on there. This is an out of phase stock. This Deckers is an out of phase stock. You can see here the stock's been going up. Actually had really good news in a quarterly number, and the structure maybe isn't as well defined as the other one, but to the upside. And FCN is one that just had some good news and reestablished the uptrend here. I think TW is probably the one I'm going to pick right now. Okay, so here's our out of phase stock. Now when I look at this, I'm going to say, okay, what's the trend here? And kind of what I see is something like this. 1, 2, 3. All right. Came up, went sideways, went up again. Now, this is probably really more representative of this sort of price action at its heart, with this little dip in here, where it went up, went sideways, and went up again, where I would see this whole thing more as a time correction. Semantics, you know, however you want to do it. It doesn't change the fact that this last move is an impulsive surge right here. Okay. All right. Now, as you look at this, the question is going to be, what I think is going to happen here is that it pulls back somewhere and makes a new high. The question is, where does it stop on the pullback? Right. So that's the point that I want to enter this thing. So this section hasn't happened yet, but this is what I'm anticipating. It could do this, it could do that. You know, anywhere from here all the way down to here. So we got to try to make some educated guesses on where that might be. Now, when I look at this whole thing right here, this whole thing looks like a base to me. It's sloppy, it's a thin stock, and it's jumping around quite a bit. But I'm going to use this whole thing as a base. Why? Well, what it did was, let me draw this right here. It's messy, but it came up, it went sideways, and it broke out to a new high. All-time new high for the stock, I believe. Is it? Yeah. Okay, up, sideways, over. So that area is of interest to us, and that's what we call a demand zone. Yeah, I'm just going to put a DZ right there. All right, and then there's also this area down here, where I had a surge up off this little dip right there, and then it surged again. All right, so it could be one of these two areas. I'm favoring this one right here. Now, I can even go down. Let me go down a time frame, and let's see if there's anything of interest to happen in between. And there isn't. You see this sharp impulsive move up. There's no pause. There's nothing. So it's probably going to be something in here. Go back to 65. All right, get rid of that. Okay, and then let's add some extra tools in to see if we can't isolate this. Not as helpful. Our VWAP's right in the middle of these two. Let me see if I started from here, what it does. Yeah, it gets us up in there. This big surge right here. Yeah, maybe I'm going to use that. Let me get this out of here. And then let me go ahead and get the fixed volume profile. All right, hold on, it's not lining up the right way. Let's try it again. Yeah, it's showing this big buildup before it took off here. So I'm getting some, a little bit conflicting signals between the two. Or, there's a lot of volume right there for this move. We see another secondary kind of bubble in volume, but the point of control is definitely down here. Okay, so I got to make a call here as a trader. Which one do I do? I didn't prepare this before. Like, I'm just kind of showing you how you walk through it. I'm going to go with this one up top here, but I'm probably going to go deeper down into the zone and look for a retest of the VWAP is really what I'm going to do. So, this area is of interest. I'm really going to look for a retest of this VWAP right about, what's that price? 86.95. So let's just call it 87 right there and see if I can't get in at that level. All right, so that would be a setup that I'd look for at this point, or any kind of weakness that's in here. If I think it's going to move across the range, I'm looking for to get in with my out of sync or out of phase stocks. Now, let's assume, and that's an example of the out of phase stock, the TW. Let's assume now it's made a rally. Let's say I missed that trade. Let's say I get in the trade and we get up in this area and I'm thinking, okay, it's going to reverse. So I'll probably find some way to get out of the trade or have a trailing stop or something like that. But now what I'm really looking for an entry, now that the SPX has come back up into the zone, we're at 42.29, 42.30 in that area, I'm now looking for a short trade. All right, so then what I would do is I would go to my in-sync stocks or my in-phase stocks. And a good example would be something like MasterCard. Okay, let's take all this stuff off the MasterCard. Okay, and we can see here, we got a really big gap on some bad earnings the other day, but we got a nice shelf or zone area above it, which should be an interesting place possibly to short this thing on a close of the gap. All right, so when I'm looking at this from a structural standpoint, 1, 2, 3, impulse, correction, impulse. We're in sync with what the S&P is doing. 1, 2, 3, 1, 2, 3, 1, 2, 3. Okay, they're moving together. Now, when I look at this, my in-phase stock, I definitely see this area right here, which we'll call a supply zone. I'll make it red. Apply some selling. And I don't see anything else, really. I don't see a lot else. This is going to make a pretty simple decision for me. I'm not seeing anything else that's really attractive in here. All right, let me grab my VWAP, and I'm going to stick right at the start of this thing, which is right here. Maybe a little more. Let's see. Yeah. Okay, so basically right at the start of this decline, I anchored the VWAP. So the VWAP is already right now a little bit below that. All right. And then let's use the fixed volume profile. And the point of control is right through this area as well. All right, so we've got a supply zone right here. I got my point of control, which shows me that most of the volume that's trading this leg down traded right here. I've got a gap, and I wouldn't be surprised to see a attempt to close the gap. And I got my falling VWAP, anchored at the start of the decline, right? To show me that during this decline, most of the average price for the shares trading this decline coming down is at this point 380, right around there. Okay, so this makes this a pretty good entry point. Now, I'm not going to go too far up on this one. I would probably go more towards the bottom of this zone right here, try to get filled and look for this thing to close the gap, or, I really look for something that kind of shot up here. Could have got me in around this area, or look for like a reversal candle, like a candlestick, maybe a shooting star or something like that. That happens, something that implies a reversal, and use that for an entry right in this area. And that's an example of a in-phase trade. Here's our area of interest right here. All right, we're looking for a reversal right in that area. All right, so this is an in-phase trade, syncing up with the S&P. All right, we pull this together a little bit, and you can see that right here. That's an example of an in-phase trade. Oh, get rid of that. Okay, so that's how you sync up with the S&P. This one concept, and you could riff on it. You can come up with different ways to do it with the same idea in the core of it. This is really going to increase your probabilities of success in your equity trading. It makes a big difference. It made a huge difference for me. I think it's one of the most important things you have to learn. So the first thing is to learn how to do a trade, apply that to the indexes, and then figure out how to sync up the equities with the index correctly using a method like this. If you have any questions, let me know. I'm happy to answer them. Okay, thank you.